Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're excited to have you join us today. We're starting off with some big news from the telecom sector. Bharti Airtel has announced plans to invest a whopping 20,000 crore into its newly formed non-banking finance company, Airtel Money. This move is expected to power the company's next growth engine as it further diversifies its portfolio. The investment will be made over the next few years, with Bharti Airtel contributing 70% of the funds and its promoter group, Bharti Enterprises, pooling in the remaining amount. Airtel Money received its certificate of registration from the Reserve Bank of India earlier this month, authorizing it to operate as a Type 2 non-deposit accepting NBFC. This means the company can now offer loans, microcredit products, and structured financial solutions, but cannot accept public deposits. The newly formed NBFC will leverage Airtel's digital assets, a team of over 500 data scientists, and operational expertise to expand access to financial services in India. In other news, brokerage firm Jefferies has cut its price targets for several Indian IT stocks, citing the impact of artificial intelligence on the sector. The firm has downgraded stocks such as Infosys, HCL Technologies, and Emphasis, citing concerns about the disruption caused by AI in the IT services space. Meanwhile, the Securities and Exchange Board of India, or SEBI, is cracking down on illegal loan apps and other unregistered financial platforms. The regulator has issued warnings to several companies operating in this space, reminding them to register with the authorities and comply with relevant regulations. We'll be keeping a close eye on these developments and bringing you more updates as they happen. For now, it's clear that the world of finance is evolving rapidly, with new technologies and innovations disrupting traditional business models. As investors, it's essential to stay informed and adapt to these changes to make the most of your investments. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're continuing our discussion on the latest developments in the tech and automotive industries. Today, we're focusing on Tesla, a company that's been making headlines with its innovative electric vehicles and autonomous driving technology. Recently, there have been some concerns raised about the safety of Tesla's robotaxi fleet, with reports of 5 new collisions involving the autonomous vehicles in December 2025 and January 2026. This brings the total number of crashes reported in the fleet since June 2025 to 14. While these incidents are certainly a cause for concern, it's worth noting that Tesla has been transparent about the accidents and has reported them to the National Highway Traffic Safety Administration, NHTSA. From an investment perspective, analyst sentiment on Tesla is mixed. Some analysts have assigned a buy rating with a consensus one-year median price target of 480, implying a 17% upside. However, others have maintained a sell or hold rating, citing concerns about the company's valuation and the challenges it faces in scaling its autonomous ride-hailing operations. It's also worth noting that Tesla is not the only company operating in the autonomous vehicle space, and there are other players that may offer greater upside potential with less downside risk. As always, investors should do their own research and consider multiple perspectives before making any investment decisions. On the other hand, some experts believe that Ferrari could be a more attractive investment opportunity, given its strong brand reputation, high profit margins, and growing demand for luxury electric vehicles. Ferrari's target customer is extremely wealthy, which provides a high floor for financial results, and the company's valuation is currently relatively low compared to its historical average. Ultimately, the key to making informed investment decisions is to stay up to date on the latest developments and to consider multiple perspectives. As we continue to navigate the complex and ever-changing landscape of the tech and automotive industries, it's essential to remain vigilant and to be prepared for any potential risks or opportunities that may arise. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at some significant developments in the global economy. First off, let's talk about China's latest move to blacklist 20 Japanese entities, including affiliates of Mitsubishi Heavy Industries. This escalation in tensions between Asia's largest economies comes after Japanese Prime Minister Sanae Takaichi's electoral victory. The ban prohibits exporters from supplying dual-use items to these companies and also restricts overseas entities from providing them with Chinese-originated dual-use technology. In other news, copper prices have seen a significant surge due to speculation about potential easing of U.S.-China trade tensions. This development has major implications for industries reliant on the metal, such as construction and electronics. Additionally, Loblaw has announced plans to invest $2.4 billion in 2026, including the opening of 70 new stores, which could indicate a positive outlook for Canada's retail sector. It's essential for investors to stay informed about these global events and their potential impact on markets. As we've discussed throughout the show, geopolitical tensions, trade policies, and corporate investments can all significantly influence investment decisions. Remember, it's crucial to approach investing with a balanced perspective, considering both the risks and opportunities presented by these developments. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.